Today we have with us David Grossman. Now you mentioned A lender before, okay? And I've heard the term A, B, C lenders. How many are there anyways?
Well, I would say A, B, C. Some lenders can go to Z,
yeah.
But I would put them into. I think those are good categories. A, B, and C. Yes.
Okay, those are the normal ones.
Those are the normal ones
you would talk about, right? So can you tell me, who are they? Like, what makes an A lender, a B lender,
Sure.
a C lender, and perhaps what are some of the pitfalls that might accrue to dealing with one or the other or the other? You know?
Right. Okay. So there are basically three different types of lenders, Richard, and we classify as A lenders, which are essentially prime lenders or bank type of lenders that most people would like to get a mortgage from. That's where you get the best rates. And the best terms too. Right?
Other than banks, who else is in that category?
Well, there are credit unions, trust companies, and there are many institutions out there that we consider to be A lenders that people have never heard of, that serve strictly the mortgage brokerage community.
Gotcha. Okay.
So, no shortage of A lenders out there, but they look for people who have very good credit and provable income. And the next category is a B lender. A B lender is also an institution who will take self-employed borrowers, so they're more flexible in how they look at income, and also more flexible on credit as well. So if people have credit issues, they might still be able to get a mortgage from a B lender. So the B lender will charge maybe a percentage point, sometimes more, sometimes less, premium over what the bank's charging.
So the banks are charging 3.5. The B
So
lender
the
might
B
go
lender
4.5.
4 to 5,
4.25,
depending on
5.
the situation. Right. So that's a B lender, and you know, it's if you can get your loan from an institution, either an A or B lender, that's the best case scenario. If you're in a pinch, there are C lenders, which are also known as private lenders.
Okay.
Private lenders include individuals who just like to lend out money on mortgages, MICs, which stands for Mortgage Investment Corporations, that do private loans. And these are higher risk types of loans that you wouldn't be able to get from an institution, so you pay higher rates, you pay fees. So besides the fact that they're more expensive and should be avoided if possible, the other thing about the private loans or the C mortgages is that they're usually short-term loans. So lenders will want to know what's your exit strategy, or how are you going to repay the loan, and that's an important question.
Right.
As a borrower, if you need it as a bridge to get over a hump, okay, but you know, you got to think long term, right? What's going to happen at the end of the year? If this is a 1-year term and that lender is not prepared to renew the loan at the end of the year, because private lenders don't always want to renew, and if they do, the fees could be very high. So that's, you know, you need to have a plan to get out of that private mortgage, either by refinancing at the end of the year or selling the property.
So for anybody, whether they're a first-time buyer or anything at all, the idea is to try and get an A lender mortgage, right?
Ideally, you want an A loan, but I also deal with a lot of people who don't mind dealing with B lenders. They don't mind paying a little bit higher because it allows them to save a lot of money on their taxes, because they're not shy about writing down the legitimate business expenses, and they can sometimes save you know, a lot of money on their taxes, and still get the loan, the mortgage loan they want, and they don't mind paying a little bit higher rate if it gets them into the property that they really want and can afford.
The Glass is Half Full Talk Show.